Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. That's what my goal is, to be done in around 25. I talked about an SPX trade on Friday, and the markets are just too volatile to be doing something. It was called a weirdo, and I'm going to put it together for you. We're going to do it at a different point in time, but with the markets down, the VIX is way up. We can look at an SPX bearish butterfly, and I don't mind that as much. We broke below the 6,000 level in the SPX. We got the S&P 500 index trading right now at 5,992. It's down 20 bucks on the day, and we've seen the VIX shoot up to the 19% level. So if I was looking to do anything, I could look at selling some call premium in the VIX index as a short-term trade. But I don't like the setup, and that's part of the reason why we wait for Mondays. I don't like the setup for the weirdo in this situation. And I mentioned on Friday's show that the markets, the way they are, have been very, very difficult to trade because there's just so much uncertainty in the marketplace. And I was kind of surprised actually that the VIX would trade down as low as 14 or 15, considering the amount of potential news that could hit at any point in time based off of what's going on with the administration and the uncertainty of all the news headlines that come out. Now, annoyingly enough, we went back and looked at a chart in IWM. Now, I personally did this trade, and I got out of the trade, but I did it at a different time than on the show. But a long straddle in IWM, and it didn't really pan out. I don't think it did on the show. I don't quite remember the strikes because sometimes I get confused with my own trading with the show, with what we do on Options Guide TV. But I kind of like it right here. As a matter of fact, I don't think I would mind getting bearish in. I've been very confused. I'm going to go out 1,000 days just to get a little bit more, and then let's zoom in right in this corner. 200-day moving average definitely provided some support. You know, it's had a tough time breaking through that. But just congestion through here, the initial breakdown, then we had, this is basically since the election. So we'll go all the way back. Here's December 17th when we had the big move down, stayed in this channel. And this channel is actually about 10 points wide. 230, let's go down to this lower end of the range here in this recent channel, down to about 220. So if you're buying on the high of the channel and you're selling on the low, you're still close to 10 points. But this is the move that you wanted, and I didn't have it on. I didn't have the IWM straddle on, but this is the move that I was anticipating with inflation starting to creep back in, with tariffs, with everything. Small business, small companies obviously are very, they're on the edge. They're on the edge of being profitable, of becoming a mid cap, of everything. So if there's uncertainty in the marketplace, it usually will affect the small caps. Inflation hurts a little bit more. Tariffs can hurt a little bit more. And I just kind of expected to get this type of move a little bit later on. But now we've definitely broke below the 200-day moving average. So if I were to do anything at this stage, I would look at doing maybe a put spread, because you got this gap up here where you had three really big white candles all the way through, and we broke off the 200-day moving average, and now we're down below it. So IWM is interesting. Maybe I don't mind this trade. Let's make it a paper trade. Let's do an IWM put spread, just old school IWM put spread. All right, let's put it together. Yeah, I just decided that right now, because I promised you an SPX trade. I promised you that we were going to do a weirdo in the SPX, which I haven't, which is a version of an iron condor, a little bit like our open wing butterflies that we've been looking at. But I like I said, the marketplace has been tough and choppy. So the iron condor has been a solid trade. If you think of all the going almost all the way back to the election, we did have some strong moves right after the election to the upside. So in this instance, if I'm thinking about the S&P 500 index, that would be the strategy to be in. And we haven't really talked about it too much, but I don't want to do it today. I just don't like where the markets is at today. So let's make it IWM. So ignore my description for the show today because it's talking about SPX, not IWM. All right, let's do it. Let's go and let's get some time here. I want some time for this to play out. So we're going to go at 21 days. We're going to go to the March 25th expiration. And we're going to buy a little bit in the money on the put side of things. We're going to look at the 217 strike put, and we're going to buy the $530 put. Now, I don't mind buying this put outright, but if we look at a 1 standard deviation move, we've had a jump up in implied volatility, obviously, pointing to the VIX that isn't there. Trading right, well, now it dropped off a little bit, but it was just at 19 a second ago. So we're going to get some value for this. We're going to get a little bit of pumped up implied volatility. This is trading at a 23 vol. And the fact that we're doing it on today on the down move makes me want to not buy the put outright, right? So let's preference that, and that the market has gone down, the vol has gone up. We're seeing it in the VIX, and it's also true in the Russell 2000 index. And if you look at it even relative to the historical for this expiration, the historical is at about a 20% implied volatility, and this is trading at a 22.5%. So 2.5 vol points is still it's a decent amount in an index. Let's put it that way. So if we're going to go out 25 days, we're going to buy this. We want to sell some of that juice. We want to sell some of that premium. And the options, the Tradier Pro options grid highlights where the 1 standard deviation move is at. And we can confirm that right about the 204 strike is about a 1 standard deviation move. Based off of the delta, we're looking at the 203 strike. So it's somewhere right around the 204, 203 level. And we're still getting a decent amount of premium there. Right at the 203 strike, we're getting 132. So the marketplace thinks that there's a 16% chance that the market can get down to 203 over the next 25 days. And why not sell some of that juice? We've waited till the move came in. The move has came. The market is down, breaking below the 200-day moving average. We're down about 0.75%. Implied volatility is up. We're going to sell the 203 right at the 1 standard deviation move. Let's do this one. I like that. And this will be our this will be our paper trade for today in IWM as an alternative to the S&P 500 index. We're just going to buy a put spread. We are going to buy the March 21st expiration, 217 strike put, and sell the March 21st expiration, 203 strike put. We're going to pay $3.88 for this. And let's send this to the what if calculator. And we're going to have a wide range for profitability. So in this instance, once again, one of the things I do like about going a little bit wider on this trade is there's a couple of things that can happen. Okay. We're bringing in $1.35. We have some days to expiration. The fact that we are how many points wide on this? 14 points wide. If the market does go up a little bit, an alternative is to just play with our put option, which wants the market to go up, with our short put option, I should say, that wants the market to go up. So since we are 14 points wide, if it starts going up, we paid $5.23 for this. Let's say it goes up to the point where this is trading for 50 cents, right? We could potentially buy to close it and roll it up to maybe the 210 strike or the 212 strike. And we could bring in a little bit more premium to help offset the loss on the longer term option contract. So if I'm going wide and this pumped up implied volatility and volatility skew actually in the puts is helping us out to go wide enough and still get some premium. on an option contract that is, I think it's 25 days away. Let me jump back to there. Yeah, 25 days away. And if we do that, that is kind of going to be our one move. Well, market moves up. We see this thing trading for around 50 cents. We roll it up and try to bring in another extra buck to help pay for the cost of our long put, and then hope that the market comes back. And anything can happen in IWM. It doesn't always behave well as far as the charts are concerned, because it's news drives so much in the small caps, and that's part of the reason why I wanted to do a long straddle to start with. I don't know if anybody did that long straddle well over a month ago, but if you look at 30-day at the money straddle, when we did it, the 30-day at the money straddle was about okay. So this is the official paper trade. I got it in a what if calculator. I'm going to take the screenshot and we'll follow it because we've got 25 days on this. And if we need to make an adjustment, our adjustment would be on the downside to buy this back and maybe sell the 210 or the 212 and try to make premium on this option contract. Well, we're hoping that the market just goes down. That's going to be our adjustment on the trade. We're going to look at the 32-day. Let's see what that is. Yeah, it's 11 bucks. Okay, so you're going out 32 days. And if you bought the at the money straddle, clear it out. Let's do that again. Dang it, swing and a miss. 216, where are we at? 216.32. Yeah, we want to buy this. I want to buy that. $11.20. So 32 days. It's not exactly 30 days. But when we looked at it, it was trading for about $10.50 for about 30 days. But I don't remember if it was, 28 days and this is 32 days, because, that obviously matters. So we're at $11.21. So if you look at the chart from low to high in the IWM, like right here, this move alone basically took care of the cost of the long straddle. 212 down to 217, or 226 down to 217. That's nine points. Where's the very bottom of this? Get out of here, you stupid little. Need to get that blue marker out of there. There we go. 217. Yep. So that move in itself would have made a long straddle profitable, right? On the put side, because you would have had enough intrinsic value plus the time value remaining to make that trade profitable. And then you got another move down to this side. So in here was chop. You would have had to buy on the high or buy on the very low of this little choppy channel, or buy on the very high in order to get that 10-point move that you need. But bottom line is, if you're doing a straddle and you pay $10 for it, you have to be able to go back and look and say, okay, over a 30-day period, how many times did it make a $10 move? And that's just the way that it is with a long straddle. And it's that simple. I don't like to do long straddles on companies that are going to announce news, because it's already known. The volatility is usually pumped up more than it needs to be around a known news event. And then it comes off after that noon event, called a volatility crunch. But in something like the IWM, which has small caps that are very susceptible to news headlines, especially in the economy, and you just don't quite know exactly how it's going to react. Like, look at this move from here, going back not that far. When is this? This is actually over the Christmas holiday. We went from 232 all the way down to 220. So that was a 12-point move. Huge move this way on the upside. But this chop, you got to get a little bit worried about the chop from time to time. And we got some chop in here. And I didn't anticipate chop, especially with all the news headlines. And we finally got a breakout. And it looks like we're below the 200-day moving average. We've touched that a few times. Yeah, I like this trade. As a matter of fact, I think I might put this one on. I like where it's at. I'm going to take a couple more seconds to look at it. But the long straddle, this is where it's at. You're paying up a little bit more juice than when we put it on. I don't like the long straddle as much as just being bearish with the put spread. And the fact that we can go so wide, still bring in some premium with 25 days, gives us one adjustment if the market starts going up. Try to make some, paying $5 for a just in the money put option. Yeah, I don't mind it. Don't mind it at all. All right, Home Depot. So my other trade that I mentioned in the description is Home Depot. Home Depot's announcing earnings, and we're doing it because they're announcing earnings. And because I was annoyed that we were not going to do a SPX trade, and that we were not going to do the weird door in the SPX. So I'm going to run in and look at the what if calculator and look at the Home Depot long butterfly spread. Okay, so we can do this for a decent net credit in the account. So we're going to do the good old fashioned skip strike butterfly in Home Depot. And it's an alternative to selling a short call spread. So let me send this to the ticket. Let's go back to here. Let's look at Home Depot and bring this all the way back. So February 28th, Home Depot's announcing tomorrow before the open. And this is the expiration that matters, the February 28th expiration. Part of the reason why I picked Home Depot is that they're announcing tomorrow, and we're doing the show today. So they're going to be announcing tomorrow. The stock is at 383.37. Going to go out about a 1 standard deviation move based off of the pumped up implied volatility. And we're going to look to do what's called a skip strike butterfly. And we're, oh man, so it was 22 cents. Where did that happen? Now it's 10 cents. And we're going to do this for a net credit. I want to get 20 cents for this. So I would wait to see if I can get 20 cents for it. I would adjust it. The market's got to move a little bit up in order for that to happen. So the market's dropped a little bit on us. Do I really need to adjust this 5 points? Well, I'll keep it here. It's at a 12-cent net credit. It was 20 cents when I was first looking at it, but here we go. All right, we're 385, where the market is at right now. Because now we're not even with it. Yeah, the market's really moved on us already. It adjusted this by 10 cents, but $382.50, 400, 405. It's there we go. Now we're back up to 14. We're close on it. 1 standard deviation moves right at 405. All right, we'll leave it there. And if you have to, you can adjust it up because we do got 2.5 point strikes throughout. So you could go to the 402.50, but just for sake, we're going to leave it right here and we're going to talk about this trade. When I first initially looked at it, it was 22 cents to be exact, and now it's 11 cents. So you would actually already be profitable on the trade if we did it at the top of the show by a dime. All right, it's 11 cents right now. This is where it's trading. We're looking to do a butterfly, but to me, this is an alternative to a short call spread. But I'll set it up and then I'll look at the short call spread that we do as an alternative to just doing a standard butterfly outright. That short call spread means that we would be selling the 410 strike and buying the 415. And that would be whatever net credit we'd receive from that is actually going to pay for the standard butterfly. And that's the basis of a skip strike butterfly. So in this instance, we're buying the 400 strike call. We're going to sell 2 of the 405 strike calls, and then we're going to skip the 410, which would be the standard, and then buy the 415. So if we do this, net credit right now is 18 cents at the midpoint. It's going to be a little bit all over the place, but you should be able to get close to midpoint fills. We'll call it 15 and make it. That'll be the price. And you should get close to midpoint fills just because there's so much volume coming into the options marketplace today because of the earnings report tomorrow. So it helps when you have a three-legged trade to get a fill closer to the midpoint on that trade. And we're going to go to the Friday expiration, which is only 4 days away. And if we go back to the what if calculator, we already have it in there. And you look at how this trade plays out. To start with, we have pumped up implied volatility. Allows us to get it done for a decent net credit to the account. If the market at this second that we put it on moves against us, we're going to be hurting. If it goes straight to our short strike, this would hurt us right away on the move today. As expiration approaches, the green line, which I'm highlighting with my cursor, will eventually morph into the butterfly graph. Now, this won't happen until we get closer to the expiration date. Other things that will help it is if implied volatility comes in. And right now we're seeing implied volatility at 54%, and the normal historical volatility is around 30%. So I wouldn't be out of the realm to see a 20-point move in implied volatility, something closer to the historical after that earnings report. So we have a higher price stock. We have pumped up implied volatility. We got a decent width on our strikes. What if there it is? A decent width on our strikes. We're only 5 points wide. Like ideally, the wider that you can do this and get a net credit done. In other words, if I can make this long spread 7.5 points, that would be great. But it's very hard to do that and have a very wide long spread and still get this done for a net credit to the account. We do have additional risk. We have risk from 410 to 415. So if you look at the chart, here's the 410 level. That's when we get in trouble, right? The market opens up and Home Depot is wrong. Oh, well, we make our 15 cents and we move on. Nothing wrong with that. We make 15 cents on a $500 margin requirement or $15. Not like we knocked it out of the park, but still not a bad trade overall. But if the market does move up, what we'd like it to ideally do tomorrow, the best case scenario would be that it would move towards the 395 level, kind of hang out in this range, and then slowly keep drifting up towards the end of the week. Implied volatility is going to come in. It's going to get crunched, and this line is going to start morphing towards the yellow line. The green line will do that almost instantly as soon as that earnings report is done. And then as we start drifting upward, this is where the one standard deviation move is for the week, right at the 405 level. And that's where we would like it to start drifting towards. Now, with that all mentioned, if we ever hit 405, we want to get out of the trade right away. It might not give you the profitability that you want right away, right? So you're risking 400. If I can make 100 or we're risking 500, if I can make $100 or a couple $100 on this trade, that's okay. It's a decent trade. You're profitable if the market goes down. You're profitable if the market stays the same. But the profitable if the market kind of goes up, and we're profitable if the market really goes up. And then if the market blows it away, we're in trouble. So a 2 standard deviation move, we're in trouble. That's where the situation is, which can happen after earnings. So that's the alternative. That's going to be my my earnings trade for this week in Home Depot. They're announcing tomorrow. Decent setup, and it helps a lot when it's a very expensive underlying and you get pumped up implied volatility. Now, I want to highlight the fact that this is not necessarily an alternative to a butterfly. It's an alternative to a short spread. So if I were to just do a short spread on this and use that thought, you'd be looking at selling to have the same margin requirement and everything. You'd look at selling the 410 and buying the 415. So let's remove these legs and say, okay, what if we just wanted to do the short call spread? If we came in and we sold this and bought that, we'd be bringing in 39 cents. Okay. So if you thought that Home Depot over the next 4 days after their earnings report would not make more than a 1 standard deviation move, it's saying they got about, based off of the delta, 11% chance of this finishing 1 cent in the money by the Friday expiration, right? So 410 to 415, that's 5 points wide. You would bring in $40. So here's what we're doing here is the butterfly is should be priced at, if we did 15, we'll call this 40 cents. So 30. So the butterfly should be priced at about 25 cents because 25 plus 15 is 40. We got it done for a net credit of about 15 cents for the skip strike. So we're selling this short spread. And if we just sold it outright, the maximum that we could bring in is $40 with 5 points of risk. It's the maximum we could do on the trade. Even with the pumped up implied volatility, just over a 1 standard deviation move out, you're looking at 40 cents on $5. Okay. So now let's just look at the standard butterfly. That should be about 25 cents. And so let's get rid of the 415. We're going to make this one, well, let's just do it together. So the 410 is going to be a buy. So we buy the 400, sell 2 of the 405s, and we buy 1 of the 410s. That's show me $30, 40. Yeah, okay. So now it's only trading for a dime net credit. So that's it. That's all we're doing. We're selling a short spread to pay for this butterfly. And how do you make that happen? You just skip the strike. You just skip the strike. You don't buy it and sell it. You just skip it. So you get rid of this, and then you add this one. I'm just trying to do it many different ways. Now it's an 18-cent net credit to the account, almost the 20 cents. There you go. Very speculative. And when I do a lot of these earnings plays, I'm going to be blunt. I don't always do them in my account because, first of all, I do a show 3 times a week, and we do want to get creative on the show. So do it at your own risk. If you're doing this, you're doing it because you want to put a trade on and you want to do an earnings play. If that makes sense. It's fun to watch and learn. And there are some times when I'll look at a trade and not just be like, yeah, I want to do this one this week. I'm not going to put this one on at Home Depot in my own account, but it is an interesting trade nonetheless. All right. Thanks for stopping in. Do we have any questions or comments? I do not see any in the chat box. And that's it for this edition of Options Guide TV. We'll come back on Wednesday, see how the Home Depot trade played out. And I do like the IWM trade. I do like that one, especially with that breakout to the downside below the 200-day moving average. So we'll see where we're at on Wednesday. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.